I want to welcome back our audience to a continuation of the discussion which I have held and have been holding with Marcus Kleba on the subject of the importance of due diligence in the merger and acquisition process. Welcome back, Marcus. Now, as you know, Marcus, we've worked hard to develop a rather disciplined approach, a structured approach towards the gathering of the information and documents that constitute the due diligence package. Could you describe basically how we go about doing that?
This is something that I'm very, very familiar with as a result of a long amount of time spent trying to refine the process. And it really is a process. The idea is that you create a due diligence checklist which is comprehensive and covers all the different areas. And it might be areas that you're not really certain of and that might not even pertain. If you're purely a manufacturing company, you may not have a services component. You may not be dealing with hazardous material or have environmental concerns. But having said that, it's important to ask all the questions, to look at your company holistically and take a step back and say, what are all the areas that I need to be concerned about? And what we've done is created a due diligence checklist, and for the viewer's convenience, we have placed a link in PDF format to this document, and I would urge anybody viewing this presentation to go take a look at that.
This is on our website.
On our website, and as a result, it indicates the kind of questions, and it will help the CEO actually organize the information and to say, how do I have this information in there? And that's absolutely critical, because we find that one of the biggest mistakes that a company can make is they enter into a letter of intent, or they get into a position where they've received an offer to sell their business and they're considering it, but they don't have the information that the buyer is asking for. So it's important to keep all of your contracts, all of your data in an organized fashion, so that if somebody says, I need to see your human resources records, I need to see your contracts, your material contracts that are with your largest suppliers, I need to see your insurance liability coverage policies. You're going to get all of these questions in almost every instance by sophisticated buyers. And if you say, well, I don't have that, or, oh, I need to get that, or I don't know where that is, and that's your standard reply to a lot of these very specific inquiries, you're going to, again, erode trust, slow down the process, and ultimately put the price that you've negotiated on the line and in jeopardy.
Now, we've encouraged the clients that we represent, the corporate clients that we represent, to try to start pulling together this information in an orderly manner even before they anticipate the sale of their company. Mm-hmm. In this way, if, as, and when from out of the blue an offer or an indication of interest in your company arises, you're ready to respond. Now, the value in that is not only that you're able to deliver this information in a timely manner, but it also conveys to the prospective buyer that you're organized, that you have a good grip on your company, you have a good grip on all of the elements that make up the legal and financial aspects of the company. Now, when you gather this information, in what forms might you keep it? Is it all tactile, physical, or can you keep it in some other manner?
There's a big debate going on in the world as to the advantage of a virtual data room or a real data room. In this sense, a data room is actually quite literally a room in which you have kept boxes of documents that are sorted by the same letter and numbering system that we have on our due diligence checklist. Increasingly, people have asked to be provided with copies not in physical, tangible format, which is heavy, which is difficult to go through, is not searchable, especially if you've got Word or Excel documents. It makes it much easier to search through if you have it in a different form than if it's just simply printed on paper. So the virtual data room has become increasingly popular, where you can email documents or make them available online. In our mind, there is still an advantage to actually going through things on paper and having things backed up. So as a policy, our firm tends to keep everything if the client agrees with this method, which is of course always important, but we encourage our clients to keep both a real physical data room and a corresponding virtual room. And we keep a labeling system intact, and we really sort literally every single piece of data that comes in is assigned a letter and number combination tied to the checklist. And we found that it tremendously helps the organization process. And I think as a CEO, you'd be very surprised to find the information that you know and didn't know about your own company when you go through the due diligence process in the way that we help you with.
Let's talk about some of the key areas of diligence that a seller needs to concentrate on, which have the potential for enhancing the value of the company or avoiding a knockdown in price if it's negatively handled.
Mm-hmm. I think there are obviously very, very many examples that we could come up with, but in the interest of time, let's touch on three very important ones. One is financials, historical and projections. Another is material contracts, and another is intellectual property. I'm almost going to take these in reverse order because I think that intellectual property and licenses are one of the most easily overlooked and also easy to trip up areas in which we've seen our buyers and our sellers get into trouble. As a practical matter, many small companies don't do a very good job about keeping their software licenses in order, whether that's their Microsoft platforms and Outlook and Word, whether that's other programs that are run by Adobe, whether that's custom design graphics software. All of these things need to be properly documented and licensed.
Let's talk about the contracts area briefly.
In the material contracts area, it's very important that if you make a representation that you have X dollars of revenue, 40 or 50 million, and you say I have all these contracts, there's two areas in which the buyer is going to start really taking a deeper look at those contracts and have their lawyers look at it, and we can help in this process in pre-analyzing these contracts. The first is, are they really committing to buy or do the things that they say that they're going to do? There's nothing worse than saying, well, I will use my best efforts to purchase. That's different from a commitment to buy a certain amount, and that will be valued differently by a buyer. Also, in some cases, if there's a change of control, a contract may permit your customer to terminate the deal. If they don't like the company that's buying you, you really can't purport to have that contract be of value to your buyer because there's a termination right. And knowing these things is very important because, for example, as a CEO, you could go to that customer and say, if I were to sell, or under what circumstances would you agree not to terminate and preserve value for my potential buyer? There's, of course, all kinds of issues and approaches you'd have to consider, but that's a very concrete way in which the legal analysis of a contract and having it and taking it and looking at it prior to a transaction will make sure that it has the value that you think it does when you're trying to sell it.
Our practice in the firm here is to look for certain factors like you're talking about that can affect the value of any contract.
Correct.
And anything over a significant amount of money that involves a significant amount of money draws our attention in that regard. And I think we've been able to deliver a fair amount of value in that area. Let's talk about financials briefly.
I absolutely think this is very, very critical. A lot of our clients have been closely held companies. And by that I mean they're not public, they're held by families. In many cases, there are transitional issues with generations. So in some cases, a father may have a son or daughter come in and serve as chief operating officer or some other, almost heir apparent position. And what happens is that the generations decide that they'd rather not have their next generation take over the company, but they'd rather sell it to a third party. One practical example is that many times in these closely held companies, the CEO and the owner, the principal owner, is willing to give their children in the company more compensation than you would ordinarily pay. So you might have a higher salary, you might have travel expenses covered differently, you might have a vehicle purchased. And for example, if you're selling your company and you have paid, let's say your child is the COO and you've paid them $300,000 and given them a luxury car, when in fact the market would objectively pay that same chief operating officer. If you put a job listing out, you could find a qualified person for $100,000. In a practical sense, you can work with your accountants and we can help point out these areas. And what you can do is you can normalize your balance sheet. You can look at your assets and liabilities and you can say, if I strip out this unusual reality and I deduct $200,000 of compensation to my current COO, you basically could create a bottom line increase in your profitability or certainly pre-tax profit of $200,000 if you tell a buyer, well, when you come in, you're not going to overpay the COO the way I did. You're going to pay the market rate of $100,000 and save $200,000.
This recasting of the actual historical data to reflect what this business could generate in the hands of another party is an important way to position a client to generate a more favorable return.
Yeah, you could actually say that they are more likely to make more profit than you would, and as a result, they're likely to be able to pay more, or they might be able to grow the company more. All of these are arguments that you are trying to anticipate and be able to make when you actually get to that face-to-face negotiation. And this brings me to an important point. The negotiation of the purchase agreement, it could be an asset purchase agreement or a stock purchase agreement. By the time you're actually negotiating the purchase agreement, George, how many times have we seen that the battle is already lost or won? You have already agreed on general parameters of the price in the term sheet, and the diligence process has either buttressed the value that you've assessed as the seller to your company or eroded it. By the time you're negotiating the details in the contract, the value, the facts that have come out, have done so largely already, and you are in many positions too late to affect the course of the valuation or to really preserve the value because you've opened the door and you've let all of the value escape prior to really tightening your awareness and your knowledge of the fact base and all the facts and circumstances surrounding your company. So don't view say, well, when I get to the transaction as CEO, when I get to the selling and negotiation, well, that's where I'll be really dig my heels in and I won't take $1 less than X. Well, you might not have to dig your heels in and you might be pleasantly surprised and get a higher value during the negotiation phase if you've done a very good job preparing your company. So it might make it easier on you if you take a lot of these steps, and that's something we keep trying to emphasize for our clients. It's never too early to start these preparations.
Another important thing in looking at financial statements of a company is to make sure that as we look at specific line items on the balance sheet or the profit and loss statement, that those numbers that are reflecting on the seller's financials have been generated by the use of best practices, or at least acceptable accounting practices. Quite frequently, a buyer is going to pay a great deal of attention to how certain numbers are generated on those financials to make sure that they comply with the way they generate the very same numbers. Some of the areas, for example, that are subject to a lot of scrutiny because of substantial variations in the ways that the numbers are generated are the way you value your inventory, your costing systems, revenue recognition, and the like. These numbers can greatly impact the bottom line or the gross profit margin. So it's important from our point of view to look at those, determine how those numbers are generated, and make sure that the practices are appropriate. In doing that, we talk with the CFOs, we talk with the controllers, and if necessary, even the accountants of the company. Marcus, we've come to the end of another session of our presentation regarding the importance of diligence in the M&A process. We're going to take a break here and continue this discussion in a subsequent video. Thank you.